Hey folks, Simon here. Welcome to your Tao Daily update for Friday the 14th of February 2025. Happy Valentine's Day. S&P's rallied 1% on Thursday, completely just stepping over a hotter than expected PPI figure. And in fact, even the hotter than expected CPI figure didn't really rile the markets much. They opened low on Wednesday, rallied to close out pretty much on their highs, erasing most of the opening loss. So the market here is really not that worried about what's already happened. It's looking at what it thinks is going to happen. And it seems the market is looking forward to reduced government expenditures through Doge, the possibility of tariffs. All of these things could have a slightly dampening effect on GDP, which could further have a dampening effect on inflation, which net probably keeps the Fed on an easing bias. Earnings season's going great. Results have generally been strong relative to expectations. So what's not to love about the market? Well, look, I'm not bearish here, but I'm not kind of fully on board with the bull story either. A couple of things that I'm keeping an eye on. One is the Mag 7. Right, the Mag 7, it's lost trend structure here. It hasn't rolled over yet because it hasn't breached the bottom of this box. But it's, you got to ask yourself the question, can the market keep ploughing ahead without the Mag 7? Right, because these are the 7 generals that have got us where we're going. Things like the semiconductor sector, which has been an important kind of leading indicator as well, that has been chopping wood for 4 months and is not looking particularly bullish. So that if I look through all of the S&P sectors, there's really only 2 that are in clear uptrends. That is the financials and the communications. Everything else is looking, a little bit mixed or even somewhat bearish. One other thing that I think is just worth highlighting is equity valuations. If we look at the Shiller PE, the so-called cyclically adjusted PE ratio, it's currently 38.5. That's versus the average level of 17. It's in the 97th percentile, which means it's higher than it's been throughout 97% of history. All right, it was only higher than where it is now for a fairly short period during the tech boom. Now, this does not mean stocks have to fall tomorrow or next week or next month or even over the next 6 months. But what it does mean is that returns for the S&P 500 over the next 10 years are likely to be well below average. Okay, average returns for the S&P 500, they're about 10% per year. With a starting cyclically adjusted PE ratio up here, you'd expect an average annual return for the next 10 years of about 0. That doesn't mean markets are going to flatline for the next 10 years, but it means we could have a lot of sideways volatility and just not make much progress. That's what I got for you. I hope it helps, and I'll catch you next week.